Welcome to this Project 54 Intelligence Briefing. I'm your host, and today we are jumping right into an explainer that completely strips away the corporate noise to break down, honestly, one of the most massive corporate reversals we've seen this decade. We're talking about the operational fallout of BP's fundamental strategic reset. They are aggressively pivoting away from those big 2020 net zero pledges and going straight back to hydrocarbons. So if you're an energy sector B2B leader, a supplier, or a commercial partner, you absolutely need to understand the logic, the hard numbers, and exactly what this pivot signals for your own revenue pipeline. Let's get into it. Here's our agenda for today. We're doing a bottom line up front teardown across 5 key areas. We'll start with Section 1, the fundamental strategic reset. Move into Section 2, financial catalysts and pressures. Then hit Section 3, capital reallocation and divestments. After that, Section 4, governance, turmoil, and risk. And we'll wrap it all up with Section 5, the new procurement reality.
All right, Section 1, the fundamental strategic reset. Let's look at the sheer magnitude of this change.
The shift here is just stark. Think back to the old 2020 strategy under Bernard Looney. The whole vision was this integrated energy company, right? They had a standalone low-carbon unit and a massive overarching focus on hitting net zero by 2050. Now contrast that with the new reality locked in by mid-2026. That standalone low-carbon unit completely abolished. BP has been ruthlessly simplified down to just 2 core segments, upstream and downstream. The focus is unapologetically back on oil and gas, and they are driving hard toward production targets of 2.3 to 2.5 million barrels of oil equivalent per day by 2030. It's a total 180.
And if you want to know why this happened, this candid quote from former CEO Murray Auchincloss speaking to Fortune really hits the nail on the head. He said, "We just chased too much. We should have narrowed that. That's obviously what I've done now." I mean, that is a pretty incredible admission, isn't it? The green strategy was just way too over-diversified. They were trying to scale renewables, bioenergy, and hydrogen all at the exact same time while intentionally cutting oil output. They essentially lost their focus. The fundamental flaw was trying to be everything to everyone, and, well, the market absolutely punished them for it.
Which brings us to Section 2, financial catalysts and pressures. We really need to talk about the brutal financial realities that forced this U-turn. Just keep this number in your head, $15.2 billion. That was BP's profit attributable to shareholders back in 2023. It's a formidable benchmark. It's what a healthy, highly profitable supermajor looks like. But then, just 1 year later, that exact same metric absolutely collapsed. It plummeted to just $381 million in 2024. That is a complete freefall. The main driver? A statutory fourth quarter loss triggered by roughly $4 billion in impairments. And here's the kicker. Those impairments were primarily related to their transition businesses. The big green bet simply didn't pay off in the market, and it left BP trailing way behind competitors like Shell, ExxonMobil, and ConocoPhillips over a 5-year stretch. Now, you don't just watch your profit drop from $15 billion to $381 million without the sharks starting to circle. And that's exactly what happened. This catastrophic drop invited immediate activist intervention. Elliott management swooped right in, securing about a 5% stake in the company. And their mandate was loud, clear, and uncompromising. Enforce strict capital discipline, cut the excess costs, and tilt the entire enterprise right back to its core competency of hydrocarbons. Let's move to Section 3, capital reallocation and divestments. Because when a supermajor pivots, you don't listen to the PR. You follow the cash. The capital allocation blueprint here makes the directive incredibly clear. Budget is flowing aggressively straight into upstream oil and gas, to the tune of roughly $10 billion a year through 2027. On the flip side, transition investments, those green initiatives are being slashed by more than $5 billion below their prior guidance, dropping down to just $1.5 to $2 billion a year. So the budget is literally physically moving out of renewables and going right back into the ground. But look, just moving capital around isn't going to cut it when you're sitting on $22.2 billion in net debt. To drive serious balance sheet repair, BP triggered a massive divestment campaign. They set a hard target, $20 billion in sell-offs to be completed by the end of 2027. It got to the point where they even had to suspend their share buyback program just to manage this new financial reality. And check out what's actually being liquidated. They sold a 65% controlling stake in Castrol to Stonepeak, bringing in about $6 billion in net proceeds. But then look at the rest of this. U.S. onshore wind, sold.
They are currently selling half of their stake in Lightsource BP Solar. They moved most of their offshore wind into a joint venture with Japan's JERA. Renewables are being rapidly decapitalized across the board. What used to be the core divisions of their future are being quickly handed off to private equity and joint venture partners.
Okay, let's look at Section 4, Governance, Turmoil, and Risk.
A structural reorganization and asset liquidation of this size doesn't happen without some massive internal shockwaves. The dominant threat to BP right now isn't just market forces, it's execution risk compounded by some truly unprecedented governance volatility. Just track this timeline for a second. The reset gets announced in February 2025. By December, CEO Murray Auchincloss steps down. Then, in April 2026, former Woodside chief Meg O'Neill is brought in as the new CEO. Barely a month later, Chairman Albert Manifold is removed over conduct issues. That is 3 CEOs and 3 chairs cycling through in just 3 years. Yet despite all that chaos, by June 2026, the low-carbon unit was officially abolished. Because despite that executive turnstile, the strategic direction is locked in stone. Listen to this mandate from the new CEO, Meg O'Neill. Focusing BP around 2 distinct segments will reduce complexity and strengthen execution. We are moving firmly towards a simpler, stronger, and more valuable BP. The reset isn't pausing because of internal drama. If anything, under O'Neill, it's actually accelerating.
Finally, Section 5, the new procurement reality. Let's translate these massive corporate moves into hard directives for you, the suppliers. If there is only one single thing you take away from this explainer today, let it be this tactical directive. Read the capital slide, not the sustainability report. Honestly, any commercial pitch to BP today that is built around net zero positioning is pitching right into a closing door. Procurement over there is no longer leading with environmental metrics. They're leading strictly with cash, cost, and immediate returns.
So, how exactly do you adjust your vendor strategy? First off, you've got to immediately remap all your BP accounts. Forget the transition units entirely. Align your teams strictly to upstream and downstream. Second, every single pitch must lead with hard payback, capital efficiency, and free cash flow contribution. Third, brace for impact. With massive debt and intense activist pressure breathing down their necks, you should expect much harder payment terms and incredibly heavy scrutiny on any discretionary spend. And lastly, prepare for counterparty churn. If you are servicing Castrol or their wind and solar assets, your contract is probably transferring to a private equity owner as we speak, and you are going to be facing a much faster, far more ruthless, financially driven mandate from those new guys. Suppliers serving exploration, subsea, and LNG, you're in the growth lane, but make no mistake, the rules of engagement have changed entirely. So take a really hard look at your pipeline today. BP's reversal is definitely the deepest U-turn of any major this decade. But remember, they are responding to market fundamentals that are affecting everyone in the sector. So I leave you with this. As supermajors abandon the transition and scramble back to their core, is your commercial strategy genuinely aligned with the capital realities of 2026? Is your revenue architecture actually engineered for this new hydrocarbon reality? Thank you so much for joining this Project 54 Intelligence Briefing. Take these insights, go adapt your strategies, and we'll catch you in the next explainer.